Hello everyone. Well, the travel sector is once again at a crossroads with up to half of the nation's population currently in lockdowns due to COVID-19. Today, we're going to review the ASX travel sector, including 12 of the best known stocks, and ask the question, are there 3 that you could add to your portfolio right now? Well, let's kick off today with that classic question that often comes from the back seat on a long trip. Are we there yet? And unfortunately for this young chap and for many in the travel, events, hospitality industries, the answer is unfortunately no. Just today, Victoria confirming that they will go for another 2 weeks on their lockdowns. They won't be out until at least September 2nd. No end in sight for the lockdowns for New South Wales, with nearly 500 confirmed cases of COVID in that state today. Hopefully, it could be at the end of September, October. We just don't know. We've still got movement restrictions in Queensland, South Australia, Tasmania, and limits on the sizes of gatherings, and just WA and Northern Territory in the green there with no form of restrictions at this point in time. So the spectre of COVID-19, particularly this Delta variant, remains with us and is likely to remain with us for the foreseeable future. The first segment of the ASX travel sector we're going to look at is the Airlines, Airports and Aviation Services segment. And with international borders closed until at least July 2022, airlines and airports are certainly dependent on domestic travel returning to pre-COVID levels. The good news is we were on the way there, with about 60% of 2019 activity back before the last round of lockdowns. But with some form of lockdown hitting all but 2 of the nation's states and territories over the last couple of months, many travel plans have been put on hold or have been required to be cancelled completely. And it just speaks to the significant amount of uncertainty in the sector, not only for consumers that are unsure as to whether they can make a booking with any confidence, but also the providers of travel services as well. And with this unfortunate scenario as the backdrop, we're going to look at these 3 companies in this segment: Qantas, Alliance Aviation Services and Auckland International Airport. Qantas certainly was on the right track before this last round of lockdowns, having themselves predicted they were going to reach 95% of pre-COVID activity in the fourth quarter of FY 2021, that's the June quarter. Even better, the company was expecting to get to 107% of pre-COVID activity in FY 22, and based upon the travel bubble that had just opened with New Zealand, up to about 60% of Australia-New Zealand travel routes. As a result of the current lockdowns, however, brokers are expecting that domestic capacity in Q4 FY21 was more like 70 to 80% and have cut their FY22 expectations to as low as 80%. On screen, we can see various market data, broker recommendations and price targets, our estimates, summary and forecast multiples in 2 segments, firstly containing historical data and forecast data as well. Down the bottom here, we can see a chart of the net profit after tax, the dividend yield, and on the right, we can see the weekly chart for Qantas. Let's first look at the broker recommendations. We have an average of a buy with 5 strong buys, 5 buys, no holds, and 1 sell. If we look at the broker target prices, we've got an average price of $5.81, which does compare favourably to the current price of $4.54 at the time this video was made. Probably the easiest way to explain the impact of the pandemic on Qantas's earnings is to look at the net profit after tax chart, where we can see that prior to the pandemic, Qantas was making substantial profits in the order of magnitude of around $1 billion. That has plunged to an expected $1.4 billion loss for FY21, and we'll find out more when we get Qantas's full year results on August 26. Brokers are expecting a substantial bounce back and a quick bounce back in Qantas's earnings, with a profit expected for FY22 of just under $300 million, rising to close to that $1 billion mark in FY 2023. Of course, much of this is contingent on international borders opening around the middle of next year and getting out of this current round of lockdowns as quickly as possible. Looking at some of the valuation metrics now, we can see that because of that large loss expected for FY21, we don't have a PE for this year, but we are expecting that Qantas is currently trading on around 32 times next year's earnings, with that coming down to quite an attractive 9.18 times FY23 earnings. As you would expect, no dividend yield this year, with a small dividend returning in FY 2022, but no dividend really to speak of until we get to FY 23, and the prediction is for about 3.3% from there. Well, those are the broker consensus and financial metrics. Let's look at the chart now, and ideally we'd like to see the share price trending higher in both the short term and the long term to confirm for us that there is greater demand in the market for Qantas shares than there is supply, and therefore that would be a positive reflection on those fundamental expectations. It's not what we're seeing at this point in time. The long-term trend, as evidenced by that orange band there, is very flat indeed after having transitioned from an uptrend earlier this year, and the short-term trend has turned down again. In terms of the price action, we are still seeing lower peaks and troughs and a number of black candles, which indicates a significant amount of latent supply in the market. There is some support coming in just below that 450 level down to about 430, and clear significant resistance around that 550 up to about 575 level from those peaks in early 2021 and late 2020. All in all, the technicals point to a sideways trend at best, and worryingly, a potential move into a long-term downtrend if we do break below that support around about 430. Based upon our earnings and growth rate predictions for Qantas, we do see some value in the shares at current prices. Our fair value target of $5.09 isn't as bullish as many of the brokers, but it does still allow about 12% upside from the current share price. Given this, we're prepared to overlook the weakness in the technical trends and stick with a hold rating, but we do associate a high risk with that rating due to the significant uncertainty facing the airline and the high execution risk attached to achieving those earnings and growth targets. The next company is Alliance Aviation Services, a provider of charter flights, but also contract services to other airlines and airline servicing and maintenance. The COVID-19 pandemic had a relatively minor impact on Alliance Aviation's FY21 results due to the company's significant exposure to the mining sector. That's the fly-in, fly-out or FIFO workers for BHP and Santos. Their airline servicing and maintenance services continued largely unaffected, and they also increased their wet leasing contracts with Qantas, adding another 5 aircraft to that arrangement. Looking at the company's FY21 results, they have surpassed their pre-COVID levels of activity. That's a big tick. And management continues to see a strong outlook ahead for their contract and charter services, whilst conceding that their wet leasing arrangements may take a hit due to the current lockdowns. Nonetheless, they, quote-unquote, retain a positive outlook for FY22. Looking at the numbers for Alliance Aviation now, let's kick off with the broker recommendations. We do have an average recommendation of a buy, with 1 strong buy, 2 buys, 1 hold, and no sells or strong sells. The average price target from the brokers for Alliance Aviation is $4.91, and that does compare favourably to the current price of around $4.12. Note also in the NPAT chart down the bottom left that we have this wonderful step up pattern from bottom left to bottom right, with really next to no impact observable from COVID at all. We do see in the dividend yield chart, however, a bit of a gap there in June 2020. Now, the company was able to pay a dividend but chose not to on the basis of the significant uncertainty that was facing the sector. They also chose not to pay one in their recent FY 2021 results released last week. And the brokers were a little bit disappointed with that because, as you can see in the dividend yield chart, they were expecting a small dividend to be paid. Nonetheless, dividends are expected to ramp up over the next couple of financial years, reaching about 4.3% in FY 2023 and close to 4.7% in FY 2024. The valuation metrics for Alliance Aviation look quite attractive. It's currently trading on 19.7 times current year FY earnings, but due to the significant growth in earnings per share, that is expected to drop to 15.7 in FY 2022 and then as low as 11.5 by FY 2024. A company that's growing its earnings at a faster rate than its current PE will have a PEG of less than 1, and that is considered to be very attractive. So Alliance Aviation's PEG ratio of 0.6 for FY22 is impressive, and it gets even better for FY23 and FY24. And looking at the weekly chart for Alliance Aviation, we can see that unlike Qantas, it is in a long-term uptrend as evidenced by the dark green moving averages, and also a short-term uptrend as evidenced by the light green moving averages. The price action in the short term, however, is somewhat bearish, with lower peaks and lower troughs being observed as the price compresses into a trading range between the March 22 low of $3.86 and the 16th of April high of $4.92. Whilst the price remains in this zone, investors may choose to take a wait-and-see approach until the appearance of some white candles in that short-term trend zone, or potentially a breaking above the top of the trading range at $4.92. Based upon our earnings and growth rate predictions for Alliance Aviation, we see a fair value target of $5.15, which is slightly above the broker's consensus of $4.91 and provides about 25% upside from the current share price. Based upon the attractiveness of the current fair value target, we rate Alliance Aviation as a buy with a low execution risk expected. This buy rating is more suited to value investors, however, with more technical-oriented traders better suited to waiting for some of those technical signs we discussed earlier before entering. Next up is Auckland International Airport, and airports have been in the news recently with a takeover bid for our own Sydney airports launched last month. That bid has few implications for Auckland International Airport, however, as it is subject to some rather strict foreign ownership regulations in New Zealand. Another difference between the two airports is Air New Zealand's substantially higher reliance on international flights compared to domestic flights. That is, 55% of flights are international versus 38% for Sydney airports. The good news for Auckland International Airport is that domestic flights through Auckland are back up to about 90% of pre-COVID activity. The bad news is that the Trans-Tasman bubble, which was open for just a few weeks, is now closed indefinitely due to the lockdowns over here. And as a result of that, most brokers have pushed the expected recovery for Auckland International Airport out to FY24. Looking at the numbers for Auckland International Airport, starting with broker recommendations, we can see an average rating of a hold, no strong buys, no buys, and just the 2 sells, so not widely covered by brokers over here. Of the brokers surveyed, we have an average price target of $6.71, which is actually below the current price of $6.98. Looking at the net profit after tax chart in the bottom left of the screen, we can see another company here taking a massive hit on the back of the COVID-19 pandemic, but in this case only falling to a relatively small full year 21 loss of $29 million, and that is expected to bounce back in FY22 and FY23. Despite the speediness of that recovery, it doesn't look like there's a whole lot of value in Auckland International Airport shares at the moment. No PE for FY21, of course, but the company is trading on 132 times FY22 earnings, and with some growth in the business, that does fall to around about 54 in FY23. And also not greatly compelling, the dividend yield expected to rise to only 1.8% in that financial year. Looking at the weekly chart for Auckland International Airport, it is just clinging on to that long-term uptrend as evidenced by the dark green moving averages. The short-term trend's a little bit difficult to see there, but it is flat. The price action is compressing into a very tight range between the 26th of May low of 658 and the 18th of March high of 734. Given the flatness of the trends at the moment, there isn't a great deal to do based upon the technicals, but should the price break to the upside around that 730 to 740 level, it would confirm the long-term uptrend and put a far more positive spin on the Auckland International Airport chart. Given our earnings and growth rate predictions for the company, we have a fair value target of $7.23, which provides a small amount of upside from the current share price. However, it's just not enough to get us excited at this stage, so we're going with an avoid rating and a moderate execution risk given the freedom of travel within New Zealand at the moment. The next segment of the ASX travel sector we're going to look at is the travel agents and booking services segment. On screen, we can see some data from Global Data, that is the travel and tourism think tank, showing that domestic trips within Australia are forecast to return to just over 80% of pre-COVID levels in 2021. This is the so-called domestic travel boom that much of the travel industry has been hanging its hopes on. And as we're going to see as we look through the stocks in this sector, there are certainly companies that are geared towards taking advantage of this more retail, discretionary leisure travel, and companies who are unfortunately still highly leveraged to that international travel, which won't be back until July next year at the earliest. The companies we're going to look at in this segment include Corporate Travel Management, Flight Centre Travel Group, Helloworld Travel, Serko International, and Webjet. First up is Corporate Travel Management, and there's plenty to like about this one. They have a significant exposure to essential services, including government bookings. They're also more orientated to the corporate market than the discretionary retail or leisure markets. They have a significant exposure in the UK and the US, which have higher vaccination rates and are expected to rebound faster than the local market. They're back to 85% of their pre-COVID activity, at least they were before the recent lockdowns, and they can be highly profitable on their domestic travel component alone. They have a large pipeline of new client wins and a low cost base. In fact, they broke even in March and were predicting to move back to a profit by the end of June 2021. Again, that was before the recent lockdowns. They have no debt and $100 million in the bank. So there's plenty to like about Corporate Travel Management. Let's look at the numbers, which are pretty good, at least on the broker recommendation side of things. We've got an average of a buy, 3 strong buys, 6 buys, 1 hold, no sells, and interestingly, pesky strong sell down there. The mean price target is $21.20, which is below the current price of $22.25. But with the company reporting on Wednesday, August 18, there will probably be a bunch of changes to those targets. We can see there in the net profit after tax chart that it did take a significant hit on the back of COVID, but also that we're expecting a speedy and significant recovery on the other side with profits in FY22 and FY23. In fact, when you look at the net income number for FY23, it is actually well ahead of the pre-COVID level. Looking at the valuation, obviously we won't have a PE ratio for FY 2021. It is expected to come back at 45.2 for FY 22, dropping quite rapidly to just 23.6 in FY 2023. That PEG ratio, remember we said we wanted that to be 1 or lower. Well, we're getting pretty close there for FY22, but it's certainly well under that for FY23, exhibiting that there is significant growth in the business compared to the valuation. Dividend yields are expected to bounce back, but it's not typically a high dividend yield stock. We are expecting about 1.8% for FY 2023, and return on equity recovering back to above pre-COVID levels there at 20%, which is certainly well above the market average. Having a look at the weekly chart for Corporate Travel Management, we can see that it is in a long-term uptrend as evidenced by the dark green moving averages, and also a short-term uptrend as evidenced by the light green moving averages. The price action looks pretty good there with higher peaks and higher troughs, albeit compressing within a range between the 20th of July low of 1947 and the 16th of March high of 22.28. Plenty of white candles around, which indicates buying the dip or accumulation in the market. That's also constructive. And we would expect that if we were to break through that 22.88 level, we could see a move up to around the next resistance level at the 2019 highs of 28.76. Based upon our earnings and growth rate assumptions for corporate travel management, we come up with a fair value target of 25.50, which is significantly above where the brokers are at the moment and providing about 14% upside in the share price. Looking at the technicals though, we could see it trade higher than that, and on the basis of that strong technical picture and the favourable valuation, we're rating corporate travel management as a buy with a moderate execution risk on the basis that the current lockdowns do provide some uncertainty going forward. The next company we're going to look at is Flight Centre, and unlike corporate travel management, it has a significant reliance on the sale of international leisure travel. In fact, its business is split roughly 50-50 between international and domestic. And with international borders closed in many countries around the world, that is a big problem for Flight Centre. And of course, Flight Centre is a global business with operations in 11 countries. As a result of this reliance on international leisure travel, Flight Centre has only recovered as little as 20% of its pre-COVID activity, and that was before the recent lockdowns. This has forced the business to tighten its belt. It has really focused on cutting its costs. Despite that, it's still burning through around $30 million per month, but it has significant liquidity on hand, around $1.2 billion, which should get it through this crisis, assuming things go to plan. Let's look at the numbers. Kicking off with broker recommendations, we can see we have an average rating of a hold with 2 strong buys, 2 buys, 9 holds and 1 sell. So once again, quite a polarizing stock. We have a mean price target of $17.62, which does provide some upside from the current price of around about $15.17. Looking at the net profit after tax chart in the bottom left there, we can see that we are again experiencing a significant hit from the pandemic, and we are probably going to do 3 FYs in the red. So FY20 is in the bag. FY21 is almost certainly going to be a disaster, with a loss of as much as $360 million predicted by the brokers, and then another loss again in FY22. So many of the other companies we're looking at today are potentially pulling out of their losses by FY22. Not the case for Flight Centre. It won't be until financial year 23 that we turn a profit, and even then we are still a long, long way off pre-COVID levels. That means no PEs for us until FY 2023. Makes it a little bit harder to do a valuation on this one, but we are looking at 20 times that year's earnings, which actually isn't too bad, and a PEG of 0.43, which is quite attractive, and a nice return on equity of over 34%. But looking at the weekly chart for Flight Centre, I think this idea of the company being very polarizing is starting to come through, and also the significant uncertainty that sits within these fundamental numbers. The chart is looking depressed at the moment. The long-term trend is clearly down. That's the dark pink zone, as is the short-term trend. That's the light pink zone. There is a little bit of encouragement coming in from the fact there are some white candles with some lower shadows coming in towards the far right-hand side of the chart. Those lower shadows indicate accumulation and buying. However, we're still lower peaks and troughs, so the price action in the short term is not quite right, and that would lead me to believe that the modicum of support that we are seeing at 15 can hold, and it can push higher, but it's not the sort of game that I'm looking to play with my money right now. And our valuation confirms it. That is based upon our earnings and growth estimates for Flight Centre going forward. The best we can do is a fair value of $15.02, which is about 1% below the current price. And in combination with the uncertainty demonstrated in the charts and in the numbers, we have to be at a void for our rating with a high risk of execution failure. Unfortunately, our next company, Helloworld Travel, is in a very similar boat, pardon the pun, to Flight Centre, and it makes sense. They're very similar businesses. They're both highly reliant on that international leisure travel dollar. Much like Flight Centre, Helloworld is only back to 20% of its pre-COVID activity, and that was before the current lockdowns. Operationally, it continues to struggle. EBITDA and margins are deteriorating, but despite that, they had hoped to go EBITDA positive by the end of calendar year 2021. That's probably in doubt now given the current circumstances. Looking at the Helloworld numbers, starting with broker recommendations, we do have an average rating of a buy with 2 buys and 2 holds. The average price target is $2.27, which does provide a fair bit of upside from the current price of $1.57. Looking at the net profit after tax chart in the bottom left, we can see, like Flight Centre, a more prolonged downturn in profits. We're looking at 2 financial years here, FY21 and FY22, with a bounce back again not expected to FY23. When we do get to FY23, however, the PE is actually quite attractive at 9.44, but it is a long way out and therefore execution risks are significantly elevated. There's not a great deal in the fundamentals to get us all that excited, and the chart appears to reflect that lack of excitement in the broader market as well. One thing to note here on the chart is the predominance of black candles, and for me, that means there is a great deal of supply in the market lying in wait to take advantage of any rally in the price. Certainly, the price action is bearish, lower peaks, lower troughs, and we do have a long-term downtrend as evidenced by the dark pink zone and a well-established short-term downtrend as well as evidenced by the light pink zone. Unfortunately, we don't seem to be finding any major support levels at this point. We just seem to be edging lower week by week, so not a great deal to get excited about there on the chart for Helloworld. Based upon our earnings and growth rate assumptions, our fair value target for Helloworld is $1.59, which is pretty much bang on the current price, and without a great deal of upside on the fundamental valuation, and with the chart looking so bearish, it's obvious why we've gone with an avoid rating, and given the extended time frame of the recovery and the high execution risk involved in that, we've gone with a high risk rating as well. The next company we're going to discuss, Serko International, is very different from the last two. It focuses more on the corporate and government travel side of things and offers its product Zeno under a software as a service model. These models tend to have relatively high investment costs, but once they're up and running, tend to be very profitable. That's probably a couple of years away based upon their current run rate, but the company is expecting a big kick along from their Booking.com deal, where they're looking to migrate Booking.com's business clients over to the Zeno platform. The company is still in a research and development phase and a commercialization phase, and that does mean higher costs in the order of magnitude of about $28 million worth of cash burn per annum. They do have about $80 million of cash in the bank, and management is confident that that will get them through to profitability, which, as we're going to see on the next slide, should occur around FY23. Let's start with the broker recommendations. They are at an average of a buy with 1 strong buy, 2 buys, 1 hold, no sells, no strong sells. The average price target is at $7.32, and that does provide some upside from the current share price of $6.50. Looking at the net profit chart, looks very different from all of the companies we've seen up to this point, and that's because, as suggested earlier, we are in a research, development and commercialization stage, and that means expenses in the near term and hopefully profits down the track. Those profits are going to come in FY 2023 and growing exponentially quickly from there as sales ramp up, and given it is a high margin software as a service business, the profits are going to follow. Still, as tends to be the case with businesses like this, we are paying high earnings multiples. In fact, 117 times FY23 earnings, but because of the growth in the business, that does fall quickly to under 30 by FY 2024. And by that year, there will be more than enough growth compared to the price to earnings ratio to get that PEG well below that 1 that we're looking for. Not a great deal of other fundamental data there to look at, so let's head over to the chart, which looks very, very good. And investors do pay extra for growth, and this company has it. The company is a fairly new listing, and that's why it doesn't yet have a long-term trend, but we do have a short-term trend in place. That's the light green zone. The price action has moved into lower peaks and troughs in the very short term, but more broadly speaking, it is excellent, with the gains on the rallies significantly outweighing the falls on the pullback. The candles are very, very constructive for the most part. Again, the last few letting the technicals down just a little bit, but nothing goes up in a straight line, and you have to expect pullbacks in trends like this. And I think that's what we're seeing here. In a trend this strong, when there is a short-term pullback, the focus then needs to turn to where to buy that pullback. And in this case, we like to look to past areas of support, which should act as future areas of support, or past areas of resistance, which, once they're broken, tend to act as support. And the key level is around that 650 point, which is coincidentally where the price is now. Given the negativity of the short-term price action, it's probably best to wait for some white candles to appear around 650 or just above before considering entering. Based upon our earnings and growth assumptions for Serko, we have a fair value target of $8.13, which provides substantial upside of around 25%. On the basis of the growth we expect down the track, the attractive valuation and the strength of the broader trend in the technicals, we're happy to go with a buy rating on this one and a moderate risk given the time it's going to take to get to those profits and the inevitable uncertainty we're going to face between now and then in the sector. The final company in the travel agents and booking services segment is Webjet, a company that caters to all travel consumers, from mum and dad travellers through to corporates and government agencies, through its online booking portal. It also has a significant B2B division where it buys in bulk hotel beds directly from the hotels and then resells them to travel agents and other booking service providers. Webjet has built itself into a truly global business with significant operations all over the world, and it has significant exposure to countries that have better vaccination rates than we do over here in Australia, in particular the USA. Much like many of the companies in today's discussion, it has had to tighten its belt significantly, cutting its costs in half. It is still burning cash at the moment to the tune of about $5.5 million, but with over $400 million in the bank, that should be more than enough to get it through to the other side of this pandemic. Okay, looking at the numbers for Webjet now, brokers are at an average rating of a hold with 1 strong buy, 4 buys, 5 holds, 1 sell and 1 strong sell, so you could say quite a polarizing company. The average target is 513, which is almost exactly where the share price is right now. Looking at the net profit after tax chart down the bottom left, well, there's not much to look at actually. We're missing the last 3 financial years worth of data. We are showing a loss for FY 2021, a loss in FY 2022 before we strongly bounce back to profits in FY 23 and FY 24. Looking at the valuation, we don't have a PE for this year or next year, but we will be coming in at around about 23 times FY 23 earnings, and that will drop to about 17.5 times FY 24 earnings. PEG ratio is about as good as you can get at 0.07 for FY 23 and 0.5 for FY 24. Return on equity at 18.5% in FY24 is excellent. Looking at the weekly chart for Webjet, perhaps it reflects the divisive nature of this company, being split down the middle on its ratings. It seems to be split down the middle at the moment on its price action. It appears to be stuck in a range above the May low of 436 and beneath the March high of 633. More recently, it's been compressing into an even tighter range between 541 and 465. The price action isn't great. It's still lower peaks and lower troughs. However, it's encouraging to see a number of white candles on screen, and also with those important shadows pointing down towards those support levels. However, it's hard to get too excited with a long-term downtrend firmly in place. That's the dark pink zone, and the short-term trend is fairly indiscriminate. Based upon our earnings and growth rate expectations for Webjet, we have a fair value target of $6.51. That provides a significant upside of around about 26% and speaks to the quality in the underlying business. Not a lot needs to go right for this one to get back to profitability and to get back to some really impressive growth rates. However, given the weakness in the chart, the best we can do with our rating is a hold, and we have to go with high risk given the significant challenges that are still plaguing the sector. The final segment of the ASX travel sector we're going to look at today is the events, leisure and hospitality segment. And we've got quite a diverse range of companies here. Everything from cinemas to theme parks to hotels and even buses, coaches and ferries. And it's another sector that's highly leveraged to life just getting back to normal post-pandemic, and of course that fabled domestic travel boom we've all been hearing about, or at least had some legs until this last round of lockdowns. The companies we're going to investigate in this sector include Ardent Leisure, Experience Co, Event, Hospitality and Entertainment, and Sealink Travel Group. The first company we're going to discuss in this segment, Ardent Leisure, has had significant problems in the past. We're not going to go into those in this presentation simply because of our limited time, but in many ways the pandemic could not have come at a worse time. They have, however, clawed their way back to about 50% of their pre-COVID activity levels. That was before the last round of lockdowns. And much of that recovery can be attributed to their main event entertainment venues in the US, which have showed excellent growth through the first half of calendar year 2021. Unfortunately, their theme parks are still lagging and are still negatively impacted by lockdowns, both recent and current, and of course just a general lack of confidence that Aussies have now and probably will have into the future about booking interstate travel. Like many of the other companies we've discussed today, the company is burning cash at the moment to the order of $10 million per annum, and with only $18 million in the bank, they're going to need to find another solution or tap their debt facilities in the not too distant future. Looking at the numbers now, starting with the broker recommendations, we have an average rating of a buy with 2 strong buys, no holds, 1 sell, and no strong sells. We've got an average price target of $1.30, which does compare quite favourably to the current share price of around $1.04. And looking at the net profit after tax chart down the bottom left, we can see that Ardent has been in trouble from well before the start of COVID. It hasn't had a profit since 2018 and is not expected to do so until FY 2024, which is actually not on screen. So not a lot we can do in terms of the fundamental analysis, or at least the valuation-based metrics. Let's head over to the chart. We can see that the chart actually looks reasonably good with a well-established short-term trend that appears to be banging up against that well-established long-term downtrend. So we have a battle of the shorter-term traders who can see some value in the company versus the longer-term investors potentially who are still distributing stock to the market. Question is, who is going to win? I would suggest that with fairly strong price action, that is higher peaks and higher troughs, with some nice candles and with a number of tests of that late April high of $1.09.5 under its belt, there is actually a fairly high probability that this one could well break to the upside and go part of the way to reversing that long-term downtrend. So at best, it is a potential speculative buy for the more aggressive traders only on the technicals, with the longer term investors preferring to wait for that long-term trend to establish itself. Based upon our earnings and growth rate estimates for Ardent, our fair value target for the business is at $1.08, which provides about 3% upside. On the basis of the lack of perceived value in the business, and given the significant execution risk between now and when it finally gets back to profit, we can only go a hold with our rating. High risk, of course, and the hold has come about simply because of the strengthening technical picture. Otherwise, it may well have been an avoid. The next company, Event, Hospitality and Entertainment, has one ace up its sleeve, and that is you don't need to get on a plane to go to the cinemas. However, for its other operations, for example, Thredbo, Ridges and QT hotels, you at least need to get out of your suburb. Fortunately for Event, it is more leveraged to the domestic travel scene than it is to the international travel scene, and that is a positive. It certainly helped it get back to around 42% of its pre-COVID activity. That was before the last set of lockdowns. However, there is a question mark over the cinema business due to potential structural shifts in the way we consume our movie-based entertainment. Have we gotten too accustomed to all of those streaming services we binged on during lockdown? Looking at the numbers now for event, starting with broker recommendations, we have an average rating of a buy with one strong buy, no buys, two holds, no sells, no strong sells. We've got an average target of $13.30, which does compare favourably to the current price of around about $12.60. Looking at the net profit after tax chart down the bottom left, we can see just the 1 year in the red there, FY 2021, with a bounce back to profitability in FY 2022 and getting pretty close to pre-COVID levels in FY 2023. Looking at the valuation side of the ledger, no PE in FY 2021, but we are trading on about 63.6 times FY22 earnings, and that is falling rather sharply there to 21 times FY 2023 earnings. So a considerable amount of growth in the business. Don't seem to have data for PEG, but I would suggest it would be less than 1. Also good to see the dividend yield and return on equity bouncing back pretty quickly as well. Looking at the weekly chart for event, we can see that the short-term trend has swung nicely to the upside. That's the light green zone. The long-term trend technically is still in a downtrend, but because it has switched to that orange color, it is what we call indiscriminate. That is, it is potentially changing to an uptrend. What's important for me to see here is that we have broken above that long-term downtrend. And not only that, we've actually come back, tested it, and bounced off that level. You see, when we're in that long-term downtrend, that long-term downtrend zone tends to act as an area of resistance. We saw it happen late 2020, where prices fell sharply. When we get above that zone, it should then tend to act as support, and that's what it's doing now. I like the price action more broadly. It's higher peaks and higher troughs, and the candles are becoming increasingly white, and there are some nice candles coming off that long-term trend zone as well. So pretty constructive there for me on the technicals. Based upon our earnings and growth estimates for event, we have a fair value target of $13.39, which provides about 6% upside from the current share price. Unfortunately, that's not enough to get this one over the line for a buy, but if you had it, we'd certainly go with a hold on the basis of the improving technical picture. Having said that, we have to apply a high risk rating to this one, given the likely impact of the current lockdowns and, as we discussed earlier, the potential structural changes that could impact the cinema business. Moving on now to ExperienceCo. One for the adrenaline junkies. They offer skydiving tours, but also more mundane pursuits like guided nature walks, brief tours, and island hopping. Importantly, all of their experiences are located here in Australia, which gives them great leverage to the domestic travel boom. Unfortunately, however, they do have a significant exposure to the international traveller, which is no longer coming to Australia. That has caused them to lose roughly 2/3 of their pre-COVID activity, but on the bright side, the company has managed to get itself back to EBITDA and cash flow positive in the first half of this year. Looking at the numbers now for ExperienceCo, and starting with the broker recommendations, we have an average rating of a buy with 2 strong buys, no buys, 1 hold, no sells, and no strong sells. An average price target of 29 cents, which is pretty close to the current share price. Looking at the net profit after tax chart, bottom left, we can see that the company was chugging along pretty well pre-pandemic and then took a massive hit. A loss in FY20 looking to be backed up by another loss in FY 2021, albeit small losses. We're going to go to a small gain in FY 2022, and whilst there is some impressive growth into FY 2023, we're still only going to be a shadow of those pre-COVID levels. Looking at the valuation, no PE, of course, in FY 2021 and trading at an eye-watering 167 times FY 2022. That does fall significantly into FY 2023 with a PE of just 23, and given the significance of that growth rate versus the PE, we are falling beneath 1 on our PEG, which is encouraging. Not a lot of other numbers there to go on, so let's head over to the weekly chart, which does look pretty constructive as well. We do have a short-term uptrend as evidenced by the light green moving average zone. However, we are butting up against that long-term downtrend zone, which is doing its best to change. It's gone from that dark pink color to the orange color, but it is restricting price movement to the upside and certainly has done for the better part of calendar year 2021. We did get a look above it, but we've fallen back into that zone. We are being supported by the moving averages and by the previous peaks around that 28.5 and 29 cent levels right there. I'd certainly want to see a little bit more constructive price action around this 28, 29, 30 level. That is some nice white candles popping in before I got too excited. It's probably a watch at best for now on the technicals. Based upon our earnings and growth estimates for Experience Co, our fair value target is 31 cents per share, which provides about 10% upside from the current share price. That modest degree of upside, along with a somewhat constructive chart, is enough to get us to a hold with a moderate risk rating from here. We like the fact that all of the company's operations are domestically located, but until the international traveller returns, we just can't get too excited about Experience Co. The final company on our list today might be last, but it certainly isn't least. Sealink Travel Group has absolutely shot the lights out during this pandemic, substantially increasing its earnings in FY 2020 and is expected to do so again in FY 2021. The name is perhaps a little bit of a misnomer. The company actually operates a number of major public transport contracts both here and abroad, covering both bus and ferry routes. In addition to that, it has a significant exposure to the mining sector, transporting FIFO workers from airports to mine sites over in WA, and its coach business boomed as we shifted from international to domestic travel. The good times look set to continue, with the business on the verge of winning a number of new public transport tenders both here and abroad, and that leaves Sealink Travel Group in the box seat to be only one of two companies that increased its earnings through the pandemic, but also to be the only company that continued to pay a dividend. Looking at the numbers now for Sealink, starting off with broker recommendations, we've got an average rating of a buy with 2 strong buys, 3 buys, 2 holds, no sells, no strong sells. We've got an average target of $9.11, which actually is a little bit below the current price, which is interesting when you compare that back to the broker ratings. That implies that price target increases are probably around the corner. Looking at the net profit after tax chart, bottom left, we can see that profits have steadily increased from 2018, with big jumps in FY 2020 and an even bigger jump forecast for full year 2021. The growth will continue into 2023, and we think beyond that as well. Looking at the valuation, we can see that we're trading on about 31 times current year's earnings. That does fall to 25 times in FY 2022 and 22 times in FY 2023. The growth rate is significant enough to get that PEG below 1, certainly by FY 2022. That's always good to see. And the dividend yield is also increasing there and getting up to about 2.4% by 2023. So a very nice set of numbers there. And looking at the weekly chart, a very nice set of moving averages. Also, we can see the short-term moving averages. That's the short-term trend zone heading to the upside, and the long-term trend zone also heading to the upside. The price action is taking a little bit of a breather over the last few months, with the price pulling back from the May high of $10.64, got as low as $8.53 in June when it bounced off that short-term trend zone. The candles from there, including that long lower shadow on that June low candle and the more recent large white candle from week ending Friday 23rd of July, are constructive and indicative of demand returning around the support we would expect from that short-term trend zone. Based upon this solid price action in an expected area of support, we'd be happy to continue to buy around current levels with an expectation that the long-term trend will eventually resume. Based upon our earnings and growth estimates for Sealink Travel Group, our fair value target is $11.41, which provides about 19% upside compared to the current share price. Given that upside and the technical strength in the chart, we're happy to go with a buy rating on Sealink Travel, and given the nature of their business, the stability of their cash flows, we're comfortable going with a low execution risk as well. Well, thanks for sticking with me through that comprehensive look at the ASX travel sector. In the beginning, we set out to find the top 3 ASX travel stocks, but in fact we found 4. Let's recap what they are. The first company on our top ASX travel sector picks is Alliance Airlines. We have a fair value target of $5.15, which provides about 25% upside from the current share price, and a buy low risk rating. Next was Corporate Travel Management. We've got a fair value target of $25.50, which provides about 14% upside from the current share price, and we've gone with a buy moderate risk rating. The third company is Serko International. We have a fair value target of $8.13 on this stock. That gives it about 25% upside from the current share price, and we've gone with a buy moderate risk rating. The final company in our top ASX travel stocks list is Sealink Travel Group. We have a fair value target of $11.41, which provides about 19% upside from the current share price, and we've gone with a buy low risk rating. If you're thinking of investing in the ASX travel sector, we're here to help. Take advantage of over 4,100 shares and ETFs on our platform, $8 flat rate trades, your own holder identification number, 24/7 customer support, and our world-class trading app. Just head to www.thinkmarkets.com/au and you can set up an account and be trading in minutes. If you liked what you saw today, please hit the like button and of course hit the subscribe button to stay up to date on all of our ASX research videos. Thanks for joining me today for this look at the top 4 ASX travel stocks. All the best for your investing until we catch up again. Bye bye for now.